So first I want to talk about intrinsic value versus extrinsic value. Well, the stock is trading at 333.63, right? So your 332 call is going to have $1 and 62 cents of intrinsic value because it is in the money. So because calls go up in value as the stock goes up, your intrinsic value is going to be how in the money your option is. Now, your extrinsic value, so this option is going to have intrinsic value. It's that what was it? Like 20 cents plus all of the extrinsic value that this option has. So all of these options that are out of the money that don't have any intrinsic value only have extrinsic value that decays over time. Okay, so far we talked about time decay, theta, and we talked about implied volatility. Now, we're going to get into why those are important later. But now that we're done with some of the details, let's get into the fun stuff. Let's talk about how an option actually moves. So, the option's price is determined by four variables: your theta, which we talked about, your vega, which we kind of alluded to. Vega is just how the option price is affected by a change in implied volatility. And the other two variables that determine the option price and how they move are delta and gamma. So first we're going to talk about delta, and I'll jump to the trading platform to show you this. Okay, so your delta really serves two purposes. You can see it here by the puts and calls. The first purpose is that with that, like taking away the factors of all the other factors we talked about, like time decay and implied volatility, your delta is how much your option is going to move relative to how much the stock moves. So this 411 at the money call is going to move like it's 50 shares of the stock. I know we talked about how options are contracts for 100 shares, but here's another catch that you need to know. This is only going to move like it's 50 shares. This is going to move like it's 53. This is going to move like it's 59. The other thing that delta tells you is the percentage of these, is the probability of these options expiring in the money. So this 411 call that is in the money currently has a 51 chance of being in the money at expiration, so on June 2nd. Same goes for the puts. This is a 49 delta call, slightly out of the money currently. It's got a 49% chance of expiring in the money. So that's what delta tells you. Pretty simple. So let's turn on something called gamma. And this is kind of one of the variables. They're called the Greeks, by the way. This is one thing that kind of gets overlooked. And this is the rate at which your delta is going to change. So if we go up $1, your 0.51 delta call is going to be now worth 0.54 deltas. So that's it. It's the rate of change of delta. So just one more barrier to entry of these options is you always want to trade liquid underlying. So you always want your volume to be significant with respect to the share price, and you always want your options to have a high trading volume. That's going to give you the best entries and exits, and in turn, make you the most money. You want to know how volatile an underlying asset is before you trade it, right? So this IV rank right here, this tells you how volatile the stock is relative to itself. So it's a percentage of the IV range over it's a year. It's how volatile the stock is relative to itself. So now you know the basics of trading options. You know how to buy an option and you know how to sell it once you've made your desired profit, right? But now we're going to talk about selling options. And this is a little bit more of an advanced strategy. Buying options can be sometimes referred to as a YOLO, degenning, tendies, whatever you want to call it. And that's for a reason, right? Because you see how these options that you're going to buy don't really have a very high chance of expiring in the money, right? If you're going to go very far in the money and buy an option, you could be good, but it still has its risks. So buying options isn't always the best course of action when trading. One thing that's important to note that I'm not sure if I pointed out is that whatever your intrinsic value, so we talked about how this 411 call has about 16 cents of intrinsic value. That's what the option is going to be worth at expiration. Just want to note that as long as the stock price stays at 411.16, which it doesn't look like it is. You can see how this trading strategy isn't really super sustainable because the odds are simply not in your favor. And to perfectly transition into the next segment, we'll talk about selling options. So we already talked about the risks of buying options. You have the risk of your option expiring out of the money. I'd say that's the biggest risk when buying options. And this makes selling options seem like a great strategy. I mean, if most of these options are going to expire out of the money, then why wouldn't you be selling options? Well, I'd be remiss if I didn't talk about the risks associated with selling options. So if you go here and you sell this 411 call, you're going to make, if the stock goes down, you're going to collect this entire $4.76 of premium. Now that's a good bit of money. But what are the risks associated with doing this? Well, if the stock moves up, your call is going to make money, similar to as if you had bought it. And technically, selling options have unlimited risk. You can see here max loss is infinity. Now, what are the chances of this happening? So the way the market determines the implied move of the stock or ETF is based on its implied volatility. So the market always prices in a 34% chance of the market going to the implied move on the upside and a 34% chance of making the implied move to the downside. So using statistics, we always have a 68% chance, 68.2% chance of the stock price staying within the implied move. Now, if we have a stock move more than the implied move, that falls into these categories, and we call that an outlier move or tail move. So there's a 16% chance of a tail move happening on either side, which is why the strike price of the implied move on either side is always the 16 delta. So that's how we implement statistics into our trading strategy. And you can see that right here. You have an expected move of 837 between now and June 2nd.